Hello from the Morningstar Investment Conference in London. I'm Louise Babin and I have with me today Richard Woolnough to talk about fixed income. Hi Richard.
Morning.
So we were talking earlier on in your presentation about the corporate bond market and the fact that externally it looks like it's grown quite rapidly and deteriorated a lot in credit quality. It sounds like this didn't concern you, but could you elaborate on that for us?
Yeah, it's quite interesting. So if you think about a marketplace when it first starts, it's going to be limited in its size. By definition, it's going to be small. And secondly, in terms of its sophistication and depth of liquidity. So with the corporate bond markets, when it first started in sort of Europe and sterling, it was higher quality companies came because there wasn't the infrastructure to understand and follow them. But as time goes by, companies without as much security when they borrow come to the fore. New companies that you wouldn't have been able to lend before come to the fore. You can get a portfolio of risk. So it's sort of the larger market begets a larger market, and so over time you'd expect the corporate bond market to accelerate in its size, which it has done in the UK, US and Europe, and you'd expect it over time to be open to more players, not only from an investment perspective but from a borrower perspective. So basically what's happened over the last term of time, last 20, 30 years, there's been this huge development in an alternate way for companies to fund themselves besides bank lending, besides equity. They do it for the corporate bond market, and that's allowed a huge variety of international issuers, sectors and credit quality to come to the marketplace, which makes it a far more dynamic, interesting place to invest than just what it was 20 years ago.
And the kind of lower credit quality on average that we're seeing doesn't really concern you too much because you're not that worried about recession. Your expectations are for no recession. Just wondered what you're monitoring, what signals you're looking at to just make sure that that doesn't turn.
Yeah. We look at Main Street as opposed to Wall Street. It's quite common for people to look at Wall Street as a main indicator of where things go. The stock market's down, recession's around the corner. I think that can send you too many false signals and predict too many recessions as we've seen of late. So we look at things that drive the economy, where interest rates are heading, what the unemployment rate's going to be, how's the housing market behaving, and strangely enough, where the oil price is. The oil price has been a big driver of economic cycles in the past, particularly in the 70s when I was growing up. And so, we look at all those four to try to work out, how much brakes have been put on the economy and how much headwinds on the economy. And we use that to work out where we are. At the moment, the oil price has had a rally recently, but it's unchanged year on year. The housing markets are generally okay in the developed markets. We're near full employment, and in fact there's no sign of unemployment slowing down. So it's really, really hard to see why recession's around the corner. And from my opinion, the central banks are still pursuing a very dovish policy. The UK still has very low rates, Europe still has negative rates, and it takes 2 years for interest rate policy to work. So if it takes 2 years for interest rate policy to work and we've had no big increase in UK rates or European rates, then it's very hard to see how we get a recession in the next 2 years.
Interesting. Well, thank you, Richard. And from the conference, thank you very much for watching.